Welcome to the Deep Dive. Today we're getting straight to something really core for any business. We're talking about making sure that financial story, especially the income statement, is actually accurate. Think of it as your shortcut to understanding, well, corporate trust.
Right. And it's so much more than just, the numbers on a page. It's really fundamental, a pillar of good corporate governance, operational excellence even. It gives you these strategic insights.
Okay, so let's break that down. The income statement itself, the P&L, profit and loss. It's like a narrative, right? Starts with revenue, the top line flows all the way down to net income, the bottom line paints a picture of efficiency. But here's where it gets, well, really critical. A tiny slip up, just one number off. It can warp that whole story, can't it?
Absolutely. And what's crucial, absolutely essential, is that every single figure on there needs solid proof. Verifiable evidence. We call that the audit trail. It's not just paperwork. I mean, think of it as the financial DNA. If that link breaks down, say, an expense pops up with no vendor invoice behind it, it's not just a mistake. It's a big flashing warning sign. Could be weak controls, maybe even fraud. Source documents, invoices, shipping logs, payroll stuff, they're like diagnostic tools. They tell you how healthy the accounting process really is.
Okay, so given that things can go wrong, how do we get ahead of it? Are we just finding errors after the fact, or can we actually, prevent them?
Exactly. Prevention is key. And that's where something like the COSO framework is so valuable. It's basically a globally recognized blueprint for setting up and checking internal controls. COSO talks about 5 integrated parts. Things like the control environment, that's the culture, the tone at the top that values accuracy. And then control activities, that's the hands-on stuff, like proper income statement reconciliations, making sure different people handle different steps that stop small errors snowballing.
Right, so you build these strong walls first, but even then, how do you spot things efficiently? Any sort of quick checks?
Yeah, definitely. Before you dive super deep, you can do high-level analytical reviews. A really powerful one is variance analysis, simply comparing your actual results to what you budgeted or expected. And it's not just about finding a difference, it forces you to ask why. Why are the numbers like this? That leads to real business insights. Imagine suddenly your repairs and maintenance costs shoot up unexpectedly.
Right.
That makes you investigate, right? You go talk to the operations manager and maybe find out a key machine broke down. That's vital operational feedback right there from the numbers.
That makes sense. It forces conversations.
Right.
But what about digging deeper for things that might be deliberately hidden, like fraud?
Now you're getting into forensic accounting territory. And what's fascinating there is how the patterns in the data themselves become evidence. Take Benford's law. It sounds a bit weird, but it's this statistical observation. In most naturally occurring number sets, like sales figures, expense amounts, the digit 1 shows up as the first digit way more often, around 30% of the time, much more often than 9, which is less than 5%.
Really?
Yeah. But numbers people just make up, especially if they're trying to stay just under, say, an approval limit. They rarely follow that natural pattern, so it's a quiet but strong signal that something needs a closer look.
It's like the numbers have their own tell, their own fingerprint almost. And if it looks smudged, and I guess that's where tech comes into, visual tools.
Precisely. Data visualization tools are amazing because our brains are just wired to spot patterns visually. You use scatter plots maybe to see payments that look out of place, time series charts to spot weird spikes over time, or network graphs. These can actually uncover hidden links, like maybe a vendor's address is suspiciously close to an employee's home address. Connections that are almost impossible to see just scrolling through rows of data.
Okay, so technology automation, AI, it's powerful. Does that mean the human element becomes less important?
No, actually, quite the opposite. It elevates the human element. The future isn't about replacing people. It's this human-in-the-loop idea. Let the AI do the heavy lifting, sift through mountains of data, find those potential needles in the haystack, flag the high-risk stuff. But then you need the human professional to apply judgment, that crucial professional skepticism, understand the context, and really investigate those flags properly. You need that critical thinking.
So what does this shift mean for you listening, for accountants or people in finance?
It means the role is evolving, definitely. Less about just recording numbers, the traditional bookkeeping, and much more about being a strategic advisor. Using technology as a tool, focusing on critical analysis, communicating insights, solving complex problems.
So this deep dive really shows that keeping that income statement accurate isn't a one-off task.
Not at all. It's an ongoing cycle. It needs strong controls, yes, but also sharp analysis and that indispensable human judgment working together.
Ultimately, it's about protecting a company's reputation, managing risk effectively, and delivering those clear, reliable financial insights everyone needs to navigate, well, the complexities of business today. It truly is foundational knowledge.